We're just seeing tremendous growth, and it's very regionally specific. So certainly our core states where our original footprint is Illinois, Indiana, Ohio, Pennsylvania, 4 of the top 10 states for data center construction right now
Really?
are right along there. The crazy deal we just saw announced with AEP and SoftBank in Ohio, 9 gigawatts of generating capacity paired with 10 gigawatts of data center. That's roughly a 3% increase in U.S. gas generating capacity.
How do they finance these things? Did they come to knock on your door and say, I need a loan to build a data center and hook up to the grids and stuff like that?
It is a huge part. I mean, we have a tech and telecom team actually based here in New York. They do a lot of that bond issuance. They're very involved in this. Yes, it is. Certainly within the capital markets, it's absorbing a lot of capacity. We're seeing that probably pushing up interest rates a little bit across the board for corporates because there's just so much issuance. We had one company, not one of the big names you're thinking of, that was doing roughly $1 billion in issuance weekly this year was their plan. And we're seeing that across the board. The other crazy fact I love in data centers is roughly 3/4 of the expense on data center is the chips. That's a 5-year depreciation cycle. So you got to earn that capital back in 5 years when you're talking about these tens of hundreds of billions of dollars.
And I'm looking at rates. I mean, rates have been inching up here a little bit. I look at the WIRP function. Market's not looking for any rate cuts, but you guys are still sticking to your call of 3 rate cuts. That's way out of consensus.
I would say 2 to 3. If we end up with a lower oil price scenario, I think that's the big key.
Okay.
You know, it's this pivot, and obviously no economic model. And this is a great example of why economic models fail.
Yes.
You know, we didn't model an Iran war into our forecast for the year.
Yeah, not too many people did.
Yeah, kind of unusual thing. So we still see a soft labor market. When we get out there and we talk to folks, while yes, admittedly, the unemployment rate is within range. If you look at turnover, if you hear, you know, the Fed loves their speaking tours and listening tours. I certainly talk to a bunch of those folks at the Fed who do that work. And they're still getting the message that it's a relatively soft white-collar labor market, particularly for new college grads, people with limited experience. Maybe that is where AI is influencing stuff, that it's displacing some of those, you know, kids who don't have much skill yet, but need to develop it. And so we are seeing a pretty soft labor market there. But at the blue-collar end, we're still seeing a somewhat tighter labor market, and that's part of what's driving inflation, it's the services wage growth.
I mean, I'm looking here, this off AI, folks, the employment of the permanent staff at a data center, small, medium, ready? Yeah. Tops 35 people. Large hyperscale, tops 100 full-time employees.
That's not a lot.
Are these things permanently job creators? The answer is no.
No, I mean, certainly you'll have some job creation on the power side, but it's almost like you think of a nuclear plant in a town, ideally, if you haven't given too many tax breaks, in this case, admittedly. The nuclear plant is more just a really nice property tax bonus and helps the state and local governments fund themselves. And so you look at like Loudoun County, for example, they've had tremendous growth.
Loudoun County in
Virginia, which is the hub just outside of Dulles Airport, the ultimate hub of data centers.
Yeah,
I believe it's something like half their tax revenue these days. I can't remember the exact number. Sorry, please don't quote me on that. Is coming from data centers.
Market's down here. You're pulling back. I thought Ian Wyatt was driving the market lower. I'm wrong. Dow up Standard & Poor's up 70 points, now 40. Dow up 500 points, now up 301. Iran does not accept ceasefire, says U.S. talks illogical. Iran says U.S. stepped up efforts to secure ceasefire, and they go on to say Iran says truce talks not viable in current conditions. That from FARS, F-A-R-S, the Iranian news agency, and it moves the market, I would say, basically.
Yep, absolutely. Ian, so given this black swan event of the war here, how has that impacted kind of your economic assumptions, your forecasts, if at all?
Yeah, so we modeled this, looked at history. You have roughly, the estimates we have is every $10 increase in the price of WTI is roughly 0.2% to headline inflation for the next year. It's 0.05% to core, which obviously is what the Fed's more focused on. And we're focused on CPI there, but admittedly, obviously, the Fed does core PCE is their metric, which would even be somewhat less oil sensitive because of the nature of the mix there. So we do see that. We see a bit of a headwind to the consumers. But if you look back, inflation adjusted WTI, 2011 to 2014, $130 a barrel. We also were in a period there where the crack spread was unusually large too, and Brent was higher than WTI. If you think back to 10 years ago, I used to cover energy then. This is like deja vu all over again kind of happening. And so we are seeing some of those stresses on consumers. And so we expect is right now the typical consumer, whether you look at the first quintile up through the fourth quintile, so first to 80th percentile of Americans, they spend about 4% of their spending on oil, on gasoline and related products. We see that going up in the 5 to 6% range is roughly where you're talking about when you model this out, what people do.
United States unemployment, 4.4%. Ohio, 4.5%. Columbus, Ohio, MSA, 3.6%. Wow. Is it a K-shaped economy surrounding the Ohio State University?
I would say yes, Columbus is doing well. Certainly, if you look across the Midwest, the cities that have performed well post-COVID in terms of job growth are really the ones just off the Great Lakes. So it's a Columbus and Indianapolis, even getting down to Kentucky, a Lexington, a Louisville, Cincinnati. Those are probably the better job growth cities where we've seen a little stronger performance. But overall, yeah, in terms of the K-shaped consumer, we saw trends just like Clarita was talking about earlier, that it's starting to get better again a little bit. We're going back. We were seeing some of the worst stresses on consumers like rents. If you look at the market rent indexes, those have really been flat for about a year. You know, Green Street, CoStar, any of those sources, they'll tell you rents have really flatlined. That's helping those consumers. Defaults are down a little bit amongst those consumers. So we're seeing some positive signs, but certainly, you know, a jump in gasoline prices, they're going to be sensitive to that.